We are now beginning option replication using put-call parity, and this couldn't be easier. Really straightforward. Let's get our assumption out of the way. European options again, non-dividend paying stocks. So let's begin. Let's say that we have a goal. We want to get the upside payoff of an underlying, but we don't want any of the downside risk. How can we get that done? There are two ways to get that done. Strategy one is let's just buy a call option with an exercise price X, and let's invest the present value of that exercise price today so that it grows to X at time T. It's going to cost us C0, which is the price of the call option today, plus the present value of the strike price we'll put in an investment that grows at R. This is called a fiduciary call. Our downside is just what we paid for the option. Our upside is unlimited. Let's look at strategy two. Here we're just going to buy the stock and we're going to couple it with a long put with an exercise price at X. This is called a protective put. The worst that we can do is X. The best that we can do is the full upside of the stock position. It's going to cost us the stock, whatever we pay for the stock, plus the price of the put. Now let's see if we get the same payoff. Let's look at a situation where the stock price finishes below the strike price for the protective put. This is strategy two here. This is strategy one. For the protective put, what are we going to do? Well, we're not going to hold on to the stock at a lower price than X when we can put it at X. So we will put it at X and the payoff is X. What about the call option? Well, if we finish below the strike price, the call option expires worthless. However, this will grow to the value of X at time T, so we will have X. What happens if the stock price equals the strike price? For the protective put, you could put the stock and get X, but why would you do that when the stock price is equal to the strike price? You will just end up where you started. You may as well just keep it. You will have the stock. For strategy one, we can follow the same logic. We can call it away and for X, but what we're calling away equals X. So why would we do that? We would just end up with the future value of our investment. We would end up with cash equal to X. ST equals X. Here we have ST, here we have X. Well, they're the same, right? And now let's look at the stock price above the strike price. Begin with the protective put. Would we exercise the put if the stock was worth more than the strike price? No. We would just hold the stock, which is the value of ST. What about the long call? Well, we would exercise the call. We have our investment grew to the strike price X. We would give the other person that money and they would give us the stock. And what would we have? ST. Both have the same cash flows at time T. So, since both have the same payoff, their prices must be equal or else there'd be an arbitrage opportunity. This relationship is called put-call parity. Here's the protective put, here's the fiduciary call. Remember we said it would cost us the stock price plus the put price, and on the other side we said it would cost us the value of the call plus we would invest the present value of the strike price. This is called put-call parity. Given three inputs, if we knew a stock price and we knew the put price and we know what strike price we have, we could solve for what the value of the call option would be. Now, if these two sides do not equal each other, we have an arbitrage opportunity. Let's say the stock plus the put equal $20, but the call plus the present value of the strike price only equaled $18. Well, what we could do is follow the rule of arbitrage, which is buy low, sell high. We would sell this side and we would buy this side. So we would short the stock and we would short the put. We'd go long the call and long the risk-free bond with a present value of X divided by 1 plus R to the T. And wait till expiration, because at expiration we know both sides have the same payoff, but if they have different prices today, we get risk-free gains. So let's take a walk through Exhibit 1 and Exhibit 2, and then we will just algebraically change this relationship to get a whole bunch of other identities here. Example 1. In an earlier example, the V01 family office held non-dividend paying Biomian shares currently priced at $2.95 per share. VFO is considering the purchase of a 6-month put on Biomian shares at an exercise price of $2.65. If VFO's chief investment officer observes a traded 6-month call option price of 59 per share at the same 265 exercise price, what should he expect to pay for the put per share if the relevant risk-free rate is 4%? Notice the setup of the question. We're considering a put at 265. To use put-call parity, if we observe a call price, it must be at the same strike price. Notice that it is the same strike price. If these were different strike prices, you could not use put-call parity. You would have to have some option pricing formula to determine what the value of the put was. But because we know the value of the call, and we know that put-call parity must hold, otherwise there'll be arbitrage opportunity, we can figure out the value of the put, but it must be the same strike price. Risk-free rate 4%. From equation 1, put-call parity relationship was shown as the stock plus the put, a protective put, equals the value of a fiduciary call. We can solve for the risk-free bond. Over here, we know that the strike price is 265. We know R is 4%, so this is a constant. We can just put the value in right now, 259.85. We know the stock price is 295. This is the one we want to solve for, the put. We know the call is 59, and we know the present value of the strike price is 259. Well, you can add these two together, bring 295 to the other side, subtract it, you get 23.85. Again, keep this in mind. These strike prices for put-call parity to work for you, to be able to price out any of those variables, knowing 3 of the inputs to price out the 4th, the strike prices must be the same for the put and the call. Example 2. As in example 1, the V01 family office holds non-dividend paying Biomian shares at a price of $2.95 per share. VFO is considering the purchase of a put for which it expects to pay $23.85, but which is instead currently priced at $30. Assuming a risk-free rate of 4%, identify the arbitrage opportunity and steps VFO might take to earn a riskless profit. So again, here's put-call parity, the stock plus the put. Well, the put's $30, so let's add those two together, 295 and 30, you'll get to 325. But the other side, if you had 59 and 259, you will not get to the same price. The protective put is more expensive than the fiduciary call. So you follow the law of arbitrage, which is sell high, buy low. Since the stock and the put are priced higher than the fiduciary call, we want to sell this side. That involves selling the stock and selling the put, and we will buy the other side, which is buying the call option and investing the present value of the strike price at the risk-free rate for that period of time. And because we've already shown that they have the same payoff at maturity, we earn a riskless profit. By selling the put and the shares, and purchasing the call and the risk-free asset at t=0, VFO has positive cash flow of $615, and it shows you, $295 plus the 30, because we're selling, right? We're selling the shares, we're selling the puts, so we'll receive $295, we'll receive 30, but we'll spend 59 on the call, and we'll spend $259.85 on the bond. And that's how we get to the 615. And then it shows you in the diagram below. I would not spend a lot of time on this diagram. This is really just showing at each, you sell the underlying asset, our cash flow at t=0, well, you'll get S naught. That's a plus sign because it's cash flow in. Anything with a minus is cash flow out. This is just a really long, tedious way of just using logic. If I'm selling the stock and I'm selling the put, I must be bringing in 325. If I'm buying the call and I'm buying the bond, I must be putting out, 218.85. It's just that simple. It's just a lot of extra work to start writing down this. So if you're looking at this going, how do I get through all of this? Just don't. Just don't do it. It's just a ledger. You can think of this as just an accounting ledger of all the cash flows coming in and the cash flows going out, and then adding up the cash flows to figure out what you have when you could just use logic. Okay, let's get algebra out now, and let's isolate each of the terms on one side. So here's the stock, here's the put, here's the call, and here is the long risk-free bond. And if we want to replicate the stock, there it is. If we want to replicate the put, there it is. We want to replicate the call, there it is. And if we want to replicate a risk-free bond, there it is. This is called a synthetic long position. You're long the call, you're short the put. A synthetic long put is to be long the call and short the stock. A synthetic long call, you're long the stock, long the put. and a synthetic long bond, you are long the stock, long the put, and short the call. If you're long the put and short the call, that's called the synthetic short position. So you're long and you're short by the same thing. So that'll just equal the risk-free bond. If you multiply this whole thing by -1, multiply it out by -1, you'll get this over here. Negative S0 equals negative C0 plus P0 minus the bond. This is a synthetic short position. Because why? Negative S is a short position. Do the same thing for the second one. Now you have a short put. That's a synthetic short put. If you do the same with the third, you have a negative sign here, negative sign here, negative sign here, positive sign there. You have a synthetic short call. And you could do the same thing with the risk-free bond. Put a negative sign in front of here, which means you got a negative sign here, a negative sign here, and a plus sign there. You're just multiplying through by -1. Now you have a synthetic short bond. So with put-call parity, if we ever need to replicate something, if we say, well, how can we replicate a call option? Because the call options on this stock are really illiquid, but the put options are liquid. Well, here you go. That's how you can replicate a call option. Let's walk through example 3. Okay, we're looking at exhibit 3. This is not what we're doing here. We're going to example 3. I just want to point out a mistake. This is exhibit 3. The writing above it tells you to refer to exhibit 3 for a protective put, the payoff profile for a protective put. That is not what's going on in exhibit 3. So if you looked at exhibit 3 going, that doesn't make any sense to me, it's because this is the exhibit from example 3. This is not exhibit 3. So let's go down to example 3, which is down here, a covered call strategy. Recall from an earlier example that the V01 family office holds non-dividend paying Wyoming shares currently priced at $2.95 per share. Since VFO's chief investment officer believes Wyoming's share price will appreciate over the long term but remain relatively unchanged for the next 6 months, he would like to sell a 6-month call option at a $3.25 exercise price to generate short-term income in what is known as a covered call strategy. So a covered call is you're long the stock, you're short the call. So if you think about it in terms of the equation down here, it would be, there it is right there, S0 minus C0 is what we'd like to get. Using put-call parity, how can you replicate this position using a risk-free bond and a put option? And what is the expected call option premium if the put option has a price of 56? Well, we can use put-call parity for all of that. To get it into this form here, we just subtract C0 from both sides, and then we subtract P0 from both sides. You will have, there is the present value of the strike price, you're long the risk-free bond, and you've sold a put. And to solve for C0, well, we know what S0 is. It's $2.95. There's the value for S0. We are told what the put price is. It is 56. So there's the put price right there. The call price we don't know, and we know the strike price here is $3.25, and we're told that R is 4%. So that's just algebra after that. We may solve for the no arbitrage call price using put-call parity by substituting into the following equation. S0 minus C0, this is the covered call, and this is the put. This is this equation here as opposed to this one here. It wouldn't matter which one you use. You could mix them all up. You basically have 3 knowns with an unknown. It wouldn't matter. Anyways, here we go. We get 3231. This is just plugging in numbers and solving for an equation. Okay, let's look at put-call forward parity. And before we jump to the equation, you will recall we did calculate the forward price in a previous module. It's the spot price carried at the rate of interest. Well, let's just divide through by this term over here, and you'll isolate the stock price on one side, and it is equal to that. So we can take put-call parity, and instead of S0, we'll substitute in the other side of the equation. There it is right there. This is a cash position. This is a cash position. So what's interesting here is you have 2 cash positions. Reason is the forward is costless to enter. There is no cost to enter it. So to make it equivalent to put-call parity, we substitute the present value of the forward price in for the stock price over here and assume that we are going to fund this with a cash position, and this cash position will grow to the forward price over time. So that is the one little thing about it, is it's a cash position, and because we really should be writing it out like this, because the forward itself is costless to enter into. But we basically have the same equation, except instead of the stock price, we're substituting in the left side, or sorry, the right side of that equation. This is called a synthetic protective put. This is called a fiduciary call, and we can walk through to make sure that we have the same payoffs. Let's put the stock price underneath the strike price. The put will have a payoff of X minus the stock price because the put will be in the money, X minus ST. The forward will always have a payoff of ST minus the forward price. So it's the stock price at time T minus the forward price in every single case. And this, since it was a cash position, will always grow to whatever the forward price is. Add them up. X minus ST plus ST minus F naught plus F naught. So X minus ST plus ST minus F naught plus F naught gives you X. For the call expires worthless, and you will have the present value of the strike price, which is X. And if ST equals X, the put has no value. Same if ST is greater than X, the put has no value. We've already said that the payoff will always be this, and the cash position will always grow to that. ST minus the forward price plus the forward price is ST. ST minus the forward price plus the forward price, again, ST. Down here, the call still has no value because it is equal to the strike price. You could call it or you could not call it. You'll end up in the same position. So that means you do have the cash bond that matures at the strike price. So you have X in this place. But we said up here, ST equals X. So if this is ST, this is X. X also equals ST. Here, what's the payoff of a call? It is the stock price minus the strike price. And your bond will grow to equal the strike price, ST minus X plus X, ST. Notice that you have the same payoffs each and every time, identical payoffs. Therefore, they should have the same price. This is just a proof to show you that both of them, both sides, side number 1 and side number 2, will have the same payoffs. Thus, they must have the same price. Thus, we have a no arbitrage condition. It's just to make you feel comfortable in being able to use put-call parity to either replicate something. We can replicate a forward, we can replicate a put, we can replicate a call, we can replicate a risk-free bond, and given 3 of these variables, we can always solve for the 4th one without always having to think through, well, wait a minute, does this condition hold? We're showing you that it holds so that you can sort of just take this on faith and say, put-call parity works, I'm going to use it. Okay, this screen may seem intimidating, but it's just algebraic manipulation of the forward put-call parity formula. What I've done here is I brought the put to the other side and I brought the risk-free bond to the left side. And you can collect terms here because we have the same denominator. Our numerator is the forward price minus the strike price. And this whole term means the present value of the forward price minus the strike price. That's a payoff to a long forward, which means the other side must have the same payoff. The payoff to a long forward, we call this a synthetic long forward contract. You buy the call, you sell the put. On any asset, whether it be an equity, whether it be a bond, whether it be a futures contract, if you, for a given strike, it must be the same strike. If you buy the call and you sell the put, you have a synthetic long position. Down here, we're going to see that if you sell the call and you buy the put, you have a synthetic short position. You can always imitate a long position on a stock by using options. This, by the way, synthetic short, is very popular in shorting stocks that have a very high short interest and are very hard to borrow. If the underlying is hard to borrow, because you've got to borrow shares first before you short them, and if your broker says we can't find any shares to short, you're not out of the game. If there are options, you could say, well, that's okay. I'm going to sell a call and I'm going to buy a put at a whatever strike price it is. Again, must be the same strike price, and I'll create my own short position. It'll have the same payoff as being short the underlying asset. So we can create a synthetic long position. Over here, we just do some rearranging as well on this side. And you'll get X minus the forward price in the numerator. Well, that's the payoff to a short forward. This is the present value of the payoff to a short forward. And we get P naught minus C naught. Well, that's long a put, short a call. That's called a synthetic short position. So put-call parity and forward put-call parity have a lot of power in giving us the ability to use options to replicate the underlying or to use a combination of either the underlying, a risk-free bond, a put or a call to create something, whatever it is that we want to create. Here is just the forward price on one side, and all we've done from forward put call parity is move the put to the other side. Long call, short put. That is a synthetic long position, and this is a cash covered synthetic long position because you'll have the money at expiration to be able to buy the underlying. If you multiply this whole thing by -1, you will get negative the present value of the forward price. And instead of C minus P, you'll have P minus C. Instead of plus a bond, you'll have minus a bond because you're borrowing at this point. This is called a synthetic short forward. Why? Well, because the negative sign in front of that means we're short the forward. So we can create a long forward position, a short forward position, if there are options on the underlying. Let's walk through example 4. Okay, we are back to the V01 family office. Consider the V01 family office example using a long forward and a risk-free bond rather than a cash underlying position as in the prior example. Biomian shares trade at a price of $2.95 per share. VFO is considering the purchase of a 6-month put on Biomian shares at an exercise price of $2.65. If VFO's chief investment officer observes a traded 6-month call option price of $59 per share for the same $2.65 exercise price, what should you expect to pay for the put option per share if the relevant risk-free rate is 4%? So what do we have? We're going to need a number of things, and this is already put it in the form that we need. Take put call forward parity and just algebraically move things around so that on one side you have the put minus the call. And here is the strike price minus the forward price. This is the present value of that. Do we have a strike price? We were told $2.65. Do we have a forward price? Well, we don't, but we can get a forward price. The stock is $2.95. We're looking at 6 months and the risk-free rate is 4%. So we can calculate what a forward price is. So it would be $2.65 minus that forward price discounted to the present. And for the put and the call, we are told that we have the price. A 6-month call option is $59. We can put $59 in here. We just have to solve for the call price. Substituting terms and solving for the forward price, we get 300.84. There's the $2.95, 1.04 for 6 months. And there is our put minus the call price because we've already seen that. $2.65 is X minus the forward price. And then, of course, we'll take the present value of that. That is just plugging numbers into here, right? And we'll get $23.86. This module ends with an application of put call parity, and the application is to credit analysis. This what we're doing in this section forms the basis of something called the structural model of credit analysis, which you'll see more of at level 2. Let's begin with this very straightforward equation. The value of a firm is equal to the sum of its equity plus its debt. I think that's pretty straightforward. We'll make an assumption on the debt here to make it nice and simple. Let's assume this is just a 0 coupon bond and it's going to mature with a face value of D at time T. Now let's fast forward to time T. So on our timeline, T equals 0. That's where we are here. And we're going to fast forward into the future. The debt is now due. What are we going to do? Let's say the value of the firm is greater than the face value of the debt. Well, the debt holders get paid. They'll get D. Shareholders get everything else. So they'll get the value of the firm minus D, which is the equity. What if the value of the firm is less than or equal to the face value of the debt? Shareholders in a corporation have limited liability. As soon as the value of equity goes to 0, they're done. Well, in this case, the value of the equity is 0, so the shareholders would say, let's just default. Give the bondholders all the assets. Who cares? So the bondholders will get all the assets. They'll get the value of the firm. Shareholders get 0. So let's look at it in terms of their payoffs here. The debt holder has limited upside. The most they can get is the face value of the debt. But they have not limited downside. I don't like to say unlimited downside because it is not unlimited. It goes to 0, so it is limited in a sense, but it's not limited in the sense that the upside is limited. So I use the words not limited downside, which means they can lose more on the downside than their upside has. So they will get the minimum of either the value of the firm, whatever the value of the assets are, or the face value of their debt. So since the debt holders were holding the debt of the company, they are long the bond, and they are implicitly short a put option here. They sold the put because the shareholders can put the value of the assets to the bondholders if the value of the assets are less than the strike price here being the value of debt. The shareholder has limited downside because the most they can lose is the equity. But they have unlimited upside because if the company does really, really well while the bondholders don't participate, the best they can do is D, shareholders get everything else. So the shareholders have a maximum of either 0 or the value of the firm minus the debt because they have to pay the debt. The shareholders are basically long the assets of the firm, and they are long a put. They are long a put, and the bondholders are short the put. They're long the put, which means if the value of the assets are less than the face value of the debt, they can put the assets to the debt holder and say, there you go, they're yours. So they're long a put with a strike price equal to D, which is a long assets, long put. That's a protective put. If you use put call parity, it's equivalent to being long a call option on the assets of the firm. This exhibit gives a visual representation of what we just saw on the other side. The vertical up here is the value of the firm. This is the value of debt. This is 0. So as we go from 0 up to the value of debt and higher, we get to the value of the firm. This is the realm of equity here being greater than 0, and below it equity is less than 0. If we are below D, here's what the bondholder gets. And notice that the best they can do is D, no matter what value the firm gets to. This here represents the value of our equity. It is just a growing amount. As the value of the firm increases, the value of the equity increases because it's everything above D. So if you think better in pictures, there you go. Let's start with put call parity over here. Let's just make a few adjustments here. Instead of a stock price, we have the value of the firm. So let's substitute V0 in for S0. Instead of a strike price on an option, our strike price on debt is just the face value of the debt. So let's substitute that in there. And let's bring the put to the other side to isolate the value of the firm here. So using put call parity, the value of the firm is the value of a call option on the assets. What's the call option on the assets worth? It's worth the equity. It'll either be worth something because we'll be up above this value, or it'll be worth nothing because we'll be below that line. So this is really just equity. Plus, this is the present value of risk-free debt. This is important now. Listen up. This is the present value of the risk-free debt. And remember, we had to buy the put, so that takes away from the proceeds we got from the debt. You're probably thinking, no, you're wrong. This is risky debt. This is the present value of risk-free debt. This is what we paid the other side to take that risk, because this is not risk-free debt. This makes this risky debt. So let's say that we raised $1 million. Or that the face value of the zero coupon bond is going to be $1 million, and based on its present value, we raised $925 today. But we had to buy a put. And remember, the debt holders are selling us the put, and they say, yeah, give us $40,000. Well, we have to pay $40,000, which means we didn't get $925, we got $885. But we're going to owe $1 million. Risk-free rate gets us down to here. The put gets us down to here. This whole thing represents a risky rate. That is why we can use it in credit analysis, is to arrive at a measure of a credit spread. Valuing the put leads to a measure of credit risk, and the value of the put, as we can see here, if we think about it in terms of the yield, can be interpreted as the credit spread. We know what the risk-free proceeds would be from the bond. We know what we paid for the put, so we know what our net proceeds are. Then we can assume that this is what we got, this is what we owe. We'll have T and R, and we could just use the time value of money to calculate what the implied interest rate is on that. And the difference between that measure and the risk-free rate must be our credit spread. It's a neat little look ahead to level 2. If you think, I don't quite see it yet, just understand that all we're doing here is showing that you can use put-call parity on the value of the firm to come up with a value for what the credit spread would be. We're going to get into a lot more detail in that at level 2 so that when you do see the structural model at level 2, you'll say, I remember seeing this at level 1. I got a very high level view at level 1, but I had questions. Now you're going to get them answered. That's it.